the daily market wrap for Tuesday, 25th of August. Some few key market developments overnight, starting with Jack, the Iran sanctions. US has imposed sanctions on more than 60 entities across Iran. What are the major impacts we've seen in the markets from some of these sanctions?
Yeah, so Trump's sort of pressing ahead with his plan to economically isolate Iran. So he's imposing sanctions on 60 entities that trade with Iran, basically trying to cut them off from sort of the Western landscape and really force them to start playing ball with the Strait of Hormuz. What we're seeing is, surprisingly, oil has actually come off over the past 24 hours. So it was sitting at about $95 a barrel heading into the weekend. It's dropped down to about 92. And that's primarily traders profit taking after a solid week last week. No major news on supply disruptions. There seems to be a sort of a reasonable flow through the Strait at the moment. So people aren't too concerned about supply. So with no drastic changes to that, people are taking the opportunity to use this and grab some profit.
And for Chinese goods, so Trump has found a way to essentially go around the Supreme Court and impose an additional tariff on overcapacity. So basically just another way for him to achieve what he was trying to do earlier in the year.
Yeah, so after his Liberation Day last year, he got overruled by the US Supreme Court, who said those tariffs were essentially illegal, and he had to wind all those back, repay a lot of billions of dollars out back from those tariffs that he clawed. And what he's managed to do is found some loopholes in the system where he can sanction countries for certain trading aspects, one of those being over manufacturing capacity, where basically he can argue governments are allowing local manufacturers to manufacture too much that the local economy can actually purchase. What this means is then cheap exports are available, and these will flow through to the US, so there'll be cheap exports, people will buy those instead of buying locally. So he's using this as a loophole to reimpose those tariffs he had on last year.
And over to Canada, so again, imposing some tariffs on Canada. So also moving into the auto industry.
Yeah, so last week we sort of flagged that there were discussions around tariffs. They agreed, the US and Canada agreed to postpone those until Friday as they were working with negotiations to try and bring these down. Basically, talks really took a turn over the weekend, soured dramatically. They've really escalated over the past 48 hours. So yeah, America's basically slapping 50% tariffs on a whole basket of Canadian goods, and they're going to extend that to auto manufacturing and exporting, and looking to bring that in at the start of next year. So that's currently sitting at 25%. It was the key thing Canada wanted to bring down, but now it's got to be doubled to 50%. Canada's quite rightly pretty unhappy about it, have vowed to retaliate dollar for dollar. Although when you look at the two economies, one severely outweighs the other, one's got all the bargaining power. And as a result, we've seen the Canadian dollar really struggle and slip off, combined with the lowering oil prices. So CAD's weakening. And
just as a reminder for the audience, why is the Canadian dollar linked heavily to oil?
Yeah, so Canada has a large natural pool of oil. It's one of their biggest resources that they export, and so they're one of the biggest exporters of oil to the US.
And coming out today, so the RBA minutes regarding their decision, so further minutes released today. And what can be the impact on these regarding the sentiment on some of the Aussie dollar, for example?
Yeah, like we talk about, the minutes give a bit of an insight behind what those rate decisions were. So they always come out a couple of weeks after those decisions, and it basically gives you the background context of what they're actually discussing when they're making these decisions. And traders will use this to try and gauge what's likely to happen moving forward. Where's the sentiment? Are they looking to increase rates further, which will push up the Aussie dollar? Are they looking to hold? What are their thoughts of inflation? What are their major concerns in the economy? So it gives a bit more colour to the picture around these interest rates, and traders really pick over them with a fine-tooth comb.
So these announcements, so they Are they typically more or less severe than the initial publication?
I think that they're less severe than the initial publication. Like with any of these macroeconomic announcements, the big changes will come with any surprise. So the RBA has been leaning hawkish for a while now. If these minutes come out and say they're actually looking to cut rates in the future rather than moving forward, we'd see a big shock and a weakening in the dollar. We're unlikely to see that, but it's not out of the realms of possibility. But certainly the actual rates themselves are the tangible impacts on currencies and the economy, so they tend to carry more weight than the minutes surrounding it.
And some big moves in the past 24 hours. So Bitcoin heading towards 80,000 after we saw that quite a big increase over the past week. It's continued through the weekend.
Yeah, we saw it trying to touch 80,000 yesterday. Couldn't quite hold at that level, but it's still working towards it. Like gold, we saw a massive increase last week, driven by the high US yields, Treasury yields. The US was trying to peg those down a bit, lower borrowing costs. That was pretty short-lived and they bounced well back. So what happened on Bitcoin was there was a short squeeze. There were a lot of investors with short positions. When the price went up, they had to sell off, liquidate, which pushed it up even further. So we saw that big spring up. But what we're starting to see now is a bit of a debasement trade where now these high yields and rising borrowing costs, people concerned with the levels of government debt. So they start rotating out of those, the currency and into the hard, finite assets to try and protect their value. So that's why we're seeing a bit of an uplift in gold and Bitcoin following on from those high yields.
And as we've spoken about, so oil coming off on the back of some of those announcements we've seen.
Yeah, I mean, with the context of oil the last few months, it's not a huge move, but it's interesting to see with sanctions being imposed that it's starting to come off. So, yeah, we can see the profit taking from the end of last week.
And the dollar CAD, again, as we spoke about previously, the CAD weakening will see the dollar CAD increasing.
Yeah, exactly. Based off, again, weakening oil and importantly, those tariffs being imposed.
And some big volatility changes. The NASDAQ, seeing a bit of movement here over the past few days in particular. What are some of these announcements and what has caused these drastic movements? Yeah,
we can just see the market trying to sort of figure out what's going on in the landscape. There's quite a few things popping up now. Trump sort of all over the place and still dealing with the bond shock from last week. So yeah, the NASDAQ has struggled a little bit, but obviously it's still at really, really high levels overall. So nothing too concerning in the grand scheme of things.
And are we still seeing a lot of those tech stocks sort of dominate and move the market around significantly? Yeah,
definitely. There's been a bit of NVIDIA news the last few days of some big deals they're doing. So yeah, there's still a load of money in AI and those tech stocks are still really strong.
We move to the chart of the day. So the cable, so the pound USD.
Yeah, so a little bit of a different chart today. We've been looking at a few channels recently, but here we've got what's called a head and shoulders, and in this case is an inverse head and shoulders. So what traders will look at on a chart is basically a head and shoulders pattern. So you sort of have a bit of a tick up on the shoulder, drops back down to what's called the neckline, ticks up even higher to the head, drops back down to the shoulders, and then goes again. So the key point here is you've got the sort of the two shoulders with the lower head, and then that yellow line is the neckline. And what traders look for here is the distance between the head and the neckline. They're looking for that to replicate on the other way, and that's where they set as their target. So that will be the top pink line with a bit of sort of historical almost back testing. Those bottom lines are probably more achievable as levels where the chart has been over the past year or so. But theoretically, the price should move towards that full neckline target, which is that top line. So yeah, another pattern that traders will be looking at when analysing charts.
So it's looking at we're looking at sort of more short-term volatility within an overall directional movement.
Correct.
And the article of the day, Jack, climate wars and fuel shortages.
Yeah, this was an interesting one. We saw, obviously, there been a big inflation shock with the oil supply because of the US-Iran sort of conflict. But they're actually starting to think there might be a secondary inflation shock, and this one's more on the farming and agriculture side of things, where they're starting to predict some food shortages globally, and what this could do with the price of food and the cost of living, and we could be in line for a second wave of inflation pressure.
Nice one, yeah, worth a read if you get some time. Any questions from the audience, guys?
So when you talked about that head and shoulders chart, certain instruments more likely to show those patterns. So, currency is more likely to do that, or is it?
Yeah, I don't. Not really. Not one set of instruments or one asset class won't have a propensity to do it more than another. It just it depends on the fundamentals, what's happening in the world, what's impacting those assets in particular. I guess the overall trader positions, long and short, where's the supply, where's the support, where's the resistance. So yeah, there's a lot that goes into it, but the head and shoulders is basically a chart pattern, so it's not restricted to any one asset in particular. Chief?
Yeah, so Iran conflict continues, treasury yields causing some issues, tariff war with Canada. How come we're not seeing some more volatility in the S&P 500? The VIX is at one of its lowest points this year.
Yeah, no, it's a good point. To be honest, I'm not too sure. I think traders are kind of, I guess, like you said, there's so much going on that traders are kind of trying to figure out what's going on. But with the amount of money and groundswell behind this AI rally, I think that's really given the floor for it all. And the S&P's had a really strong year overall, like all the indexes have and equities as a whole. So I think that AI demand has really given the floor for it all. And I think there's just uncertainty about what happens moving forward. While there's a lot of concern, we can see how quickly it's changed. So no one really wants to put a foot in either camp too heavily, because if you do predict the downfall and it goes against you, then you're out of luck. And if you predict it's just got to run like a tearaway train and the bottom falls out with the US-Iran stuff, you get caught out either side. So I think it's probably more hedging bets than anything.
Yeah, I think as well, probably as a general, the world economy is becoming less and less sensitive to some of these announcements, particularly coming out of the States, particularly in regards to the conflict overseas. We've seen, as you guys have heard over the past sort of 3 to 6 months, the amount of times the decisions have gone back and forth. I think there's a bit of a sort of global shift as to how much attention is being paid to some of those announcements when they come out. Cool. Nice one.
Thank you.
Guys.